Here is a practical process of consistently investing $100 per week to build long-term wealth. In this video, the focus is on S.P.Y. Dear wealth seeker, grab your popcorn and favorite drink as you enjoy this investment journey, where we'll be practical about S.P.Y. investment pros and cons. Here's what S.P.Y. is all about. S.P.Y. is an exchange-traded fund, ETF, that tracks the performance of the S&P 500 index. The S&P 500 is a stock market index that measures the performance of 500 large-cap U.S. companies, representing approximately 80% of the total U.S. stock market capitalization. S.P.Y. is one of the most popular ETFs in the world, and it's traded on the New York Stock Exchange. It's believed to be a great investment option for anyone looking to invest in a diversified portfolio of U.S. large-cap stocks. S.P.Y. is designed to provide investors with exposure to the performance of the S&P 500 index, which has historically provided strong returns over the long term. By investing in S.P.Y., investors can gain exposure to a wide range of companies across various sectors, including technology, healthcare, consumer goods, and more. In addition, S.P.Y. has a low expense ratio, which means that investors can keep more of their returns. It's also very liquid, meaning that investors can buy and sell shares easily and quickly. Overall, S.P.Y. is believed to be a great investment option for anyone looking to invest in a diversified portfolio of U.S. large-cap stocks. Now that you understand what S.P.Y. is, subscribe as we delve into the step-by-step process of consistently investing $100 per week for 1 year into the ETF. It is generally termed as a great investment option, but is it worth it? What are the pros and cons? Let's discover them together. Before we continue, I want to let you know that investment options should be tailored to an individual's unique financial situation, including their risk appetite, age, responsibilities, and income level. Here are some factors to consider when choosing investment options. 1. Risk appetite. Risk appetite refers to an individual's willingness to accept risk in order to achieve higher returns. Some people are comfortable taking on more risk in their investments, while others prefer a more conservative approach. Generally, younger investors with a longer investment horizon may be more willing to take on more risk, while older investors who are closer to retirement may prefer a more conservative approach. 2. Age. Age is an important factor to consider when choosing investment options. Younger investors have a longer time horizon and can afford to take more risks, while older investors may need to focus on preserving capital and generating income. 3. Responsibilities. An individual's responsibilities, such as caring for dependents or paying off debt, can affect their investment options. For example, someone with a large amount of debt may want to focus on paying off that debt before investing in riskier assets. 4. Income level. An individual's income level can also affect their investment options. Someone with a higher income may have more disposable income to invest, while someone with a lower income may need to focus on more conservative investment options. Overall, it's important to choose investment options that align with your financial goals, risk tolerance, and unique financial situation. A financial advisor can help you determine the best investment options for you based on your individual circumstances. All right, now that we have exposed some crucial factors to consider before investing, back to S.P.Y. Here are some steps to take to make your 1-year journey of consistently investing $100 per week in S.P.Y. a reality. 1. Set up an investment account. First, you need to set up an investment account. Many online brokerages allow you to open an account and start investing in S.P.Y. If you're looking to invest in S.P.Y., you can start by setting up an investment account with an online brokerage. There are many options available, so it's essential to do your research and choose one that fits your needs. There are several online brokerages available that allow you to invest in S.P.Y., including Robinhood, E-Trade, TD Ameritrade, Fidelity, Charles Schwab, and many others. Each brokerage has its own set of features, fees, and investment options, so it's important to compare them and choose the one that best fits your needs and goals. Once you've opened an account, you'll be able to start investing in S.P.Y. and other securities. It's also a good idea to consult with a financial advisor to ensure that your investment strategy aligns with your goals and risk tolerance. 2. Set up automatic contributions. To ensure you invest consistently, set up automatic contributions of $100 week to your investment account. This way, the money is automatically invested each week without you having to remember. Setting up automatic contributions for your investment account can provide many benefits. First, it helps you stay disciplined and consistent with your investments. By automating your contributions, you commit to investing a certain amount at regular intervals, such as monthly or quarterly. In this context, weekly, without having to remember to do it manually. This can help you build your investment portfolio over time and take advantage of the benefits of compounding. Another benefit is that it helps you avoid market timing, which can be risky and difficult to get right. By investing a fixed amount at regular intervals, you're less likely to be influenced by short-term market fluctuations and more likely to benefit from long-term market trends. Finally, setting up automatic contributions can be a convenient and time-saving way to invest. Once you set it up, you don't have to worry about manually transferring money into your investment account every month or quarter. This can free up your time and mental energy to focus on other important things in your life. 3. Invest in S.P.Y. Once the money is in your account, invest it in S.P.Y, which is the focus of this video. As stated earlier, S.P.Y is an exchange-traded fund that tracks the S&P 500 index. S.P.Y is a great investment option because it provides exposure to a diversified portfolio of large-cap U.S. stocks. 4. Monitor your investment. One important aspect of managing your investments is to regularly monitor their performance to ensure that they are meeting your expectations. It's crucial to keep in mind that the stock market can be volatile in the short term, meaning that the value of your investments can fluctuate quite a bit on a day-to-day basis. However, over longer periods of time, the stock market has historically provided strong returns to investors who are patient and have a well-diversified portfolio. By keeping a close eye on your investments and staying informed about market trends, you can make informed decisions about when to buy, sell, or hold your assets. Regularly monitor your investment to ensure it's performing as expected. It's important to remember that the stock market can be volatile in the short term, but historically has provided strong returns over the long term. It's time to analyze this investment option of consistently investing $100 per week into S.P.Y for 1 year. By the way, if you are enjoying this video, say yes in the comments section. Let's continue. If you consistently invest $100 per week in S.P.Y for 1 year, you would have invested a total of $5,200. Assuming an annual return of 7%, which is the historical average of the S&P 500, your investment would grow to $5,584 after 1 year. Assuming you reinvested any dividends earned and that the value of the ETF increased by the historical average of around 10% per year, your investment would be worth approximately $6,100 at the end of the year. Would you consider this kind of investment strategy? Have you ever invested a certain amount consistently over a period of time? What was the outcome? Share your thoughts in the comments section. It's essential to keep in mind that all investments come with a level of risk, and that past performance does not guarantee future results. However, investing in a diversified portfolio of stocks over the long term has historically been an effective way to build wealth. By consistently investing over time, you can benefit from compounding returns, where your earnings are reinvested and generate even more earnings. It's also important to diversify your portfolio, spreading your investments across different asset classes and sectors to help manage risk. Investment is the major route to building sustainable wealth. Whether it is investing in real estate, investing your time, money, and energy to learn a valuable skill, or investing in the stock market, the list is endless. Therefore, the fear of risk should be dealt with as a wealth seeker. Let's illustrate how fear can keep you in poverty and prevent you from fulfilling your financial goals using a character named Martha. Meet Martha, a hardworking employee at a retail store. She has always dreamed of owning her own business and becoming financially independent. However, every time she thinks about taking the leap and starting her own venture, fear sets in. Martha's fear is rooted in the belief that entrepreneurship is risky and that she might fail. She worries about losing everything she has worked hard for and not being able to provide for herself and her family. This fear has kept her from taking any steps toward her dream, and she continues to live paycheck to paycheck, struggling to make ends meet. Martha's fear of failure has also led her to settle for a job that pays less than she deserves. She is afraid to ask for a raise or to negotiate her salary because she fears that her employer might get angry and fire her. As a result, she is stuck in a cycle of poverty, unable to achieve her financial goals. If Martha can overcome her fear and take the necessary steps towards starting her own business or negotiating a higher salary, she could achieve the financial independence she has always dreamed of. But until she confronts her fear, she will continue to be held back and unable to fulfill her potential. Now let's meet Anthony, a young man who has always dreamed of becoming wealthy and successful. However, he knew that fear could hold him back from fulfilling his dreams, so he decided to conquer it. Anthony's first step was to educate himself about the things he wanted to achieve. He read books, attended seminars, and sought advice from successful people in his field. He learned that success requires hard work, dedication, and a willingness to take risks. Anthony also realized that fear was not his enemy, but rather an opportunity to grow. He embraced the fear of failure, knowing that it was a necessary part of the journey to success. He understood that every failure was a lesson and a chance to learn and grow. With this mindset, Anthony started his own business. He worked hard, took calculated risks, and persevered through the setbacks. His determination and willingness to take risks paid off, and his business became successful beyond his wildest dreams. Anthony's success didn't stop there. He continued to invest in himself and his business, always seeking to grow and improve. He became a role model for others, inspiring them to conquer their fears and pursue their dreams. Anthony's story proves that fear can be conquered with hard work, determination, and a willingness to learn and grow. If we embrace our fears and use them as an opportunity to grow, we can achieve our dreams and live a life of abundance and fulfillment. This video focused on investing in S.P.Y, but the end goal is to ensure you take your wealth journey seriously and aren't limited by your mindset and fear. I really hope you enjoyed this video. If you did, do not forget to subscribe and share it. Always consult your financial advisor before making investment decisions, as this video does not replace your due diligence. See you in our next video shown on your screen.